Welcome back to the Deep Dive. Today we are digging into US Foods Holding Corp, that's ticker USFD. Their Q3 fiscal 25 numbers came out pre-market on November 6, and, well, there's a lot to talk about.
There really is. I mean, our mission today is to try and solve what looks like a genuine paradox. On one hand, you have management delivering this just a really clean financial beat. Every metric raised guidance.
A total home run on the numbers, but then you have the market's reaction.
Exactly. The stock closed down 3.6% on the day, on heavy volume too.
So right away, you know something else is going on. Investors were clearly focused on something external, maybe macro fears, valuation, M&A chatter, and they completely ignored the operational strength. That's the disconnect we really need to unpack here.
Okay, so let's start with those headline numbers. The beat. Non-GAAP diluted EPS came in at $1.07.
Which is a huge spike, right? Something like 26% year over year.
25.9% to be exact. And it just sailed past the consensus estimate of $1.03.
And you don't get that kind of EPS growth without a solid top line.
Nope. Net sales were $10.2 billion. That's up 4.8%, also topping estimates. But the real story, like you said, is the profitability, the execution.
Right.
Adjusted EBITDA hit $505 million. That's up 11%. And crucially, they expanded margins by 28 basis points to 5%.
And 5%, I mean, we should pause on that. In the food distribution business, that is a monumental number. Every single basis point matters.
It absolutely does. It shows they're not leaving money on the warehouse floor. It's all about operational tightening.
Okay, so the company is firing on all cylinders, but the stock drops. Before we solve that puzzle, let's go deeper on the execution itself. Where did the sales strength actually come from?
Well, it's structural, and that's the key. Total case volume was up 1.1%.
Which is okay, but not amazing.
But that's where you have to look closer. If you adjust for a strategic divestiture they did, it's actually 1.6%.
Yeah.
But the real jewel in the crown, the main engine, is the independent restaurant segment.
That's their main target, their most profitable customer.
Absolutely. And their case volume there accelerated by 120 basis points sequentially to hit 3.9% growth.
Wow.
And here's the kicker. This is the 18th consecutive quarter where they've gained share in that segment.
18 quarters. Okay, so that's not a fluke. That's a real embedded competitive advantage. They are just consistently out-executing their peers.
Consistently.
Yeah.
And you also saw solid numbers in places like healthcare, up 3.9%, and hospitality up 2.4%. The chain volume was down, but that's by design.
Right. They've been pretty open about exiting some of those lower margin contracts.
Exactly. It's all part of cleaning up the portfolio to focus on what drives that 5% EBITDA margin we were just talking about.
Okay, so let's connect those dots. How are they turning that better mix into better margins? Adjusted gross profit per case was up over 5%.
41 cents, yeah. And that money isn't just, appearing out of thin air. It's from specific operational levers.
What are they pulling?
There are two big ones. First is what they call strategic vendor management. This isn't just asking for a discount. They're restructuring logistics, supply contracts. That whole initiative is on track to save them over $120 million in cost of goods for the full year.
So these are permanent structural changes to how they buy things.
Precisely. And the second lever is internal, just inventory loss reduction. Less spoilage, less waste. That's another $35 million in savings this year.
And you can't talk about their margins without mentioning their private label strategy. That seems to be their secret weapon against inflation.
It really is their structural hedge. Private label penetration with those key independent customers is now over 53%.
53%. And management said that their own brands are what, twice as profitable?
Roughly twice as profitable as manufacturer brands, yes. So while they're seeing food cost inflation of around 3.7%, they can offset that and then some by pushing their own higher margin products. It's just smart business, and it makes customers stickier.
And of course, having a healthy balance sheet allows them to make all these investments.
For sure. Their net leverage is down to 2.6 times from 2.8. Very comfortable.
Which frees up cash. They got back about $335 million worth of stock in the quarter.
4.1 million shares, shrinking the share count, which just juices that EPS growth even more.
And they're still doing acquisitions. They just announced another tuck-in deal for a company called Shetakis in Las Vegas.
Yeah. That's the fifth deal like that in about 2.5 years. It fits the playbook perfectly.
Yeah.
By smaller strategic players to build density in attractive local markets, it just makes their whole network more efficient.
So all this operational and financial strength is feeding back into technology. And this is where it gets really interesting, how they're using tech to actually generate more sales.
Right. It's not just a cost center for them. They talk about two big things. First, launching an AI-powered search on their e-commerce platform.
And they actually gave a hard number for the impact, right?
They did. A 3% higher conversion rate from that AI search. They estimate that will lead to 1.3 million incremental cases on an annualized basis.
That's incredible. So they're literally turning an IT project into a sales driver. And I assume the AI is gently nudging customers toward those higher margin private label items.
You'd have to assume so. It's a very, very smart way to align your tech with your margin goals.
And the second piece was the Pronto program, their rapid delivery service.
Yeah, their last mile moat.
Yeah.
It uses these smaller trucks to serve dense urban areas. It lets them do smaller, more frequent deliveries. It makes them super competitive.
And it's huge business, almost $1 billion in sales this year.
$950 million, on track for a $1 billion run rate by year end. And they're so confident in it. They said they're making their biggest ever annual investment in the program next year, in 2026.
That confidence definitely showed up in the guidance. They raised it pretty dramatically.
Oh, yeah. For the full year 2025, they bumped adjusted EBITDA growth to 10 to 12%. And adjusted EPS growth, they raised all the way to 24 to 26%.
And they didn't just talk about 2025. They were very firm on their long-range plan.
We were. They reiterated high confidence in their algorithm through 2027. That's about 5% sales growth, 10% EBITDA growth, and a compounding 20% EPS growth. They're selling a very clear, long-term story.
Okay, this all sounds flawless. A perfect report card. But there is one thing buried in the call, a huge strategic shift that has some serious risks. And that's the change to how they pay their sales force.
This is maybe the biggest gamble they're taking. Starting in early 2026, they're moving local sellers from a 50-50 base salary and variable pay model to a 100% variable, uncapped commission structure.
Whoa, hang on. 100% variable.
100%.
I mean, that is a massive change. You're taking away the safety net. History is kind of littered with companies that tried this and saw a huge exodus of talent.
It's a classic reason for investors to be cautious, for sure. You risk losing good, stable performers. But management's conviction is that the new structure, which is tied directly to gross profit dollar growth from independents and Pronto, well, they believe it will unleash their top performers.
So they're betting that the truly great sellers will be so motivated by the uncapped upside that it will more than offset anyone who leaves.
That's the thesis. It's a pure incentive play. Align every salesperson directly with the company's most important strategic goals.
Yeah.
It's bold.
It's very bold. Okay, so given all this, the share gains, the AI, the raised outlook, let's get back to the big puzzle. Why did the stock drop?
I think you can point to three culprits. First, just general macro sensitivity. Management even admitted there's risk from, fragile consumer confidence, a potential government shutdown.
But their biggest competitor, Cisco, just cut their outlook because of weak restaurant traffic. US Foods is clearly taking share. They seem decoupled from the macro.
They do, which proves the strategy is working. But the market is jittery. The second issue was the M&A elephant in the room. There was speculation about a tie-up with Performance Food Group.
And they were asked about it on the call.
And they explicitly declined to comment, which is the right corporate governance move, but it probably killed the hopes of anyone who was in the stock just for a quick M&A premium.
So the hot money ran for the exits.
I think so, which leads to the third point, valuation. The stock trades in the high 20s on a PE basis, so investors just took profits. They looked at the great results, looked at the high valuation and the macro uncertainty, and decided to cash in. It wasn't a vote against the company's execution, it was a vote of no confidence in the market environment.
It really does set up a fascinating situation. A great company, executing flawlessly, but punished by a nervous market, which of course brings us to our final segment.
This is not financial advice.
This is not financial advice.
Okay, so the setup is clear. You have U.S. Foods delivering its 18th straight quarter of share gains, raising its outlook,
Right.
while its biggest peer is flashing warning signs. The stock sold off for reasons that have nothing to do with the actual performance of the business.
Creating a dislocation. So the outrageous but plausible pitch is a direct bet on that divergence continuing.
It's a sector relative value trade. You go long U.S. Foods, USFD, and you simultaneously go short Cisco, SYY.
A pairs trade.
Exactly. You're betting that U.S. Foods' proven ability to execute its algorithm, powered by AI, Pronto, private label, is going to keep driving that performance gap wider, regardless of what the broader restaurant industry does. It's a bet on superior management and a superior strategy.
A clean bet on operational excellence. So, to wrap this all up, U.S. Foods delivered a fantastic beat and raise quarter. They confirmed they are a disciplined, margin-expanding, share-gaining machine. But the stock is trading on skepticism about valuation and the macro picture.
They've proven they can outgrow the market. The real question now for you, the listener, is about that massive internal change, that 100% variable sales compensation model. Will that bold, aggressive strategy actually accelerate their already impressive growth? Or is the change management risk just too big, and will it disrupt the sales force in the short term? That's the one thing to watch.